I'm Grant Mercer, and this is Storm Stock Solutions. We're getting you set up before the next opening bell, here to bring a little clarity through the chaos of the markets. The big story traders are circling is still Nvidia and the AI complex. According to Lawrence McMillan's analysis at MarketWatch, Nvidia's options are now priced for almost a perfect earnings outcome next week. Implied volatility is elevated, and the structure of that options market says expectations are sky high. That matters for the broader tape because Nvidia has become a sentiment anchor for AI, chips, and even the broader S&P 500. If the company merely meets rather than crushes those expectations, professionals will be watching for how much air comes out of the AI balloon, at least in the short term. The other major driver heading into the next session is tariffs and Main Street. We've now had several waves of analysis on the Supreme Court's decision striking down many of former President Trump's tariffs. Robert Posen writes in MarketWatch that even with the legal win, small businesses aren't suddenly made whole. Input costs went up for years, margins were squeezed, supply chains rerouted, and there's no simple rewind button. Separate reporting from Andrew Keshner underscores that consumers shouldn't expect meaningful price cuts anytime soon. The court ruling is a blow to the policy framework, but companies have already adjusted pricing and sourcing, and many may hold on to that pricing power. Layered on top of that, Robert Schroeder and Victor Reclatus highlight that one big question for corporate America is refunds. Will companies that paid those tariffs get any of that cash back? At the same time, the administration is already exploring alternative legal tools for new tariffs. So, from a macro standpoint, traders are looking at a world where the legal scaffolding has changed, but tariff uncertainty hasn't vanished. That's a recipe for continued volatility in trade-sensitive names. Let's talk about where traders are seeing opportunity and strength, at least thematically. Philip Van Doorn's piece on two major stock market trends takes the 30,000-foot view. First, the dominance of a relatively small group of high-quality leaders, including AI and big tech, continues to shape index returns. Second, income-oriented vehicles like business development companies are drawing interest from investors looking for yield and diversification beyond plain vanilla index funds. These aren't must-buy areas, but they are themes many professionals are building screens around. Quality balance sheets on the growth side, and resilient cash flow-focused vehicles on the income side. Another strength with nuance story is the tariff impact on retailers. Bill Peters at MarketWatch points out that names like Target, Nike, and Hasbro could ultimately benefit if effective tariff burdens fall. Lower input costs can be a quiet tailwind for margins. Yet, big box giants like Walmart and Costco saw their stocks soften. That divergence tells you traders are being selective. They're not blindly rotating into tariff winners. They're parsing who really gains after supply chains, contracts, and pricing have already reset. On the flip side, a couple of clear risk zones to handle with care. First, CoreWeave. Christine G reports that CoreWeave's stock dropped sharply after a roughly $4 billion funding deal, with Blue Owl reportedly ran into trouble. The company's below investment grade credit rating has made lenders nervous, raising questions about how a capital-intensive neo-cloud player can keep up blistering growth if financing gets tighter. For the broader market, this is a reminder that not all AI-adjacent plays are created equal. Highly leveraged, capital-hungry names can be fragile if credit conditions or lender appetite shift. Second, biotech blowups. Tommy Kilgore's reporting on Grail, whose stock was the Nasdaq's biggest loser after a key trial of its Gallery cancer detection test failed, is a stark example of binary risk. The trial didn't meet its primary endpoint, and the stock was cut roughly in half. That's a classic case of event risk in smaller, high-expectation names. Traders who operate in that space know the rules of the game, but for the broader market, it's a reminder. Pockets of the tape can be wildly volatile, even in a calm macro backdrop. Now, a couple of sleeper stories that could move from the background to the foreground when trading resumes. One is that Nvidia options set up itself. Even if you're not trading options, the structure of that market offers a read on crowd expectations. If we see volatility in the AI complex before the report, it could be options-related hedging and repositioning as traders try to manage risk into a priced-for-perfection event. The other sleeper is the ongoing fallout from the Supreme Court decision for specific consumer and small business names. Posen's piece makes it clear that Main Street is still nursing wounds from years of higher costs. That could show up in regional banks that lend heavily to small firms, selective industrials tied to small business capex, and certain domestically focused service companies. None of these are automatic trades, but they're stories worth keeping on a longer-term watch list as more detail emerges on refunds, new tariffs, and any targeted relief. As we head into the next session, here's the practical setup. Traders will be watching futures for how the market digests the tariff headlines over the weekend. They'll keep a close eye on AI-linked leadership with Nvidia at the core, and they'll be alert to stock-specific landmines in high-risk pockets like speculative cloud and trial-driven biotech. I'll be back with intraday updates once trading is underway to track how those themes actually show up on the screen. I'm Grant Mercer, and this is Storm Stock Solutions. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer.